maybe a little shorter, as they look at elements of this new world of this cycle and the new geopolitics of markets in abundance rather than in penury. So Amy's going to be the next speaker. She's going to look at the demand side of things, and Sarah will follow, and then I believe we'll have more than enough time for questions on and discussion on OPEC and other related things. Amy.
Great. You can't do it from now. Okay, well, it's great to be here, and it's great to see former students in the audience who are here as full economists, so welcome, and thanks to all of you for making all of us come out zing zing, because without a good graduate student, you know, your ideas are nowhere. So, and I want to thank the organization for the support it's given to the student chapters and the activities to students, because that is the future of our organization. So, but now I'm going to talk about, we talked about Bob McNally's book, but I'm going to plug my book for 1 minute, because my book with Mahmoud Al-Gamal of Rice talked about the intersection of the oil boom and bust cycle with geopolitical conflict. And at the time, it seemed like a very smart historical book, to which I'm sure a lot of people said, well, that won't be true in the future. And if we look at just, I'm going to give you a little like news summary from the last week, you can really see it again. So the thesis of the book was that we have a natural boom and bust cycle in the oil industry that's tied to the seminal business cycle, right? So as GDP is rising, demand for oil rises, there's a time lag between when the market would get the signal that it needs more oil and the time that it takes the oil industry to mobilize and spend capital and produce first oil. That was the old world. And Ed, I think, aptly mentioned that in that old world, we believed that oil under the ground would appreciate over time, right? So in that world, we had this cycle somewhere between 5 and 7 years, maybe longer, when the supply would catch up. And of course, as we all know, while we're waiting for that oil to come online and all that extra investment was coming in, the high oil prices, of course, caused or contributed to recessionary pressure and the end of the seminal business uptick in GDP, collapsing oil demand just at the time when more oil would come on the market, and therefore being the oil boom and bust cycle we've seen since the 1970s. Now, usually on the off cycles, I would find myself reminding people that it's a cycle, because every time we do an upcycle, everybody would say we're running out of oil. And I'm hoping that we've put that to death now forever. And this poll should tell you something, because we have a lot of young new members here in today's session. I'm sure they all contributed to that 63% optimism about renewable energy. But they're also the customer of the future, and they're probably likely to pick those technologies, so just pointing that out. So how does geopolitics factor in? As we noted in the book, when oil prices are going up, there's a pressure on consuming countries to sell more goods to the Middle East because of the trade imbalance that comes from this higher and higher trade deficit. And what is it that gets purchased in places like the Middle East and Russia, right? Unfortunately, in past cycles, and this past cycle when prices went up in the 2010s was no different, the bulk of the purchases are weaponry, military equipment and weaponry, right? So then what happens in the cycle? It's almost structural, right? Ed mentioned the resource curse. So countries who have invested this huge amount of capital on improving their security situation, of course, are laying the seeds for the next level of conflict, because as we know from our own activities building, we went from 1 aircraft carrier in the Persian Gulf to like 10, and it's not contributed in any way to the stability of the Middle East. Throwing military equipment at a security problem is not necessarily an effective solution. So where are we now? Where we are now is as the oil price dropped in 2014, it put tremendous stress on these resource countries that were again armed to the hilt, this time unfortunately with much more dangerous technology than they were in past cycles. And what have we seen in the last couple of weeks is that as the low oil price takes hold, maybe not the first month, second month, or third month, but as we get into the second and third year of the downward cycle, you see unrest and dissatisfaction among populations in countries where the government can no longer produce the same kind of handouts and growth anymore, right? You see more pressure on the lack of jobs, especially in countries where the population has been growing. And you see stresses come across the Middle East and in other places. And it seems to me this time with the cycle, it seems particularly bad for the geopolitical stresses, because just to remind you, things that you might not have noticed in the news because there's so much in the news, it's almost hard to focus in. There have been sabotage attacks on oil installations in the Khuzestan province of Iran, which has, I don't know, more than a third, maybe even a half of all of Iran's oil production. It's a Arab-based population, ethnically Arab population, that you wouldn't have noticed that they have a dissident movement that has been opposing the current government in Iran, except if you noticed the news report from 3 days ago that the head of this Arab opposition group in Khuzestan was gunned down in Europe, presumably by the Iranian government, right? That happened to coincide with the explosion by sabotage of an oil pipeline from Saudi Arabia to Bahrain, which followed a ballistic missile that was intercepted on its way to the Riyadh airport from Iranian-backed Houthi rebels. So what's happened? Price of oil is going back up. And, some of the analysts, Wall Street Journal had an article about how, demand is stronger than expected this year, and I'm sure that is part of it. But there still, as Ed pointed out, a lot of oil around and a lot of oil coming. So really, truly, we're back to the geopolitical cycle where we can all understand that if a ballistic missile made it to Riyadh, even though it was intercepted, obviously we could get to the point, just to be historical, Iraq-Iran war, what happened? Countries blew up each other's export terminals. And with all due respect to the shale movement, which I think has a tremendous innovation and perspective, and I'm sure capital will flow back in if the price of oil goes high enough, it's not going to replace the whole Middle East if people start actually bombing each other's export terminals the way they did in the Iraq-Iran war. So that is why I promote my book, which explained this phenomenon, which appears to be happening yet again. Now, Ed mentioned this point, which I think is a really, truly interesting one, which is, what is structurally different this time around? And I would say that although each time there's been one of these geopolitical upticks in the price of oil, there's been a technological response, and we know that. Each time the technology and the demand destruction that takes place, the potential to have it be more structural and more permanent becomes larger and larger over time. And I think that this time around, it's going to be really dramatic because there's so many technologies poised to respond if we actually had a 1979-like oil crisis. And if you think about it, I began my actual career writing about oil, believe it or not, when I was 16. You guys don't realize how long I've been obsessed with this topic. Because I had a very ambitious high school American history teacher, and he said the entire class had to enter this term paper contest. And I entered the contest with a paper about the history of 1973 and won. So, but here's my point. What got me originally focused on that topic, I think, was that when I was in middle school, I had to get up every morning at 5 in the morning to sit in line with my father on odd days, because we had an odd license plate, for the one gasoline station that was in the tiny little town that I grew up in. Well, we'll still have lines if there's a problem, but I think here more to the point, right, or maybe we just all pay higher prices, is that now you have an option. Because you can pick up your smartphone, and if you need to get to the train without your car because you couldn't fill it up with gasoline or something like that, you can ride share. You know, in the old days, how would you find out who to carpool with? You'd have to go knocking on everybody's door and see if we could put together a carpool. Now it's just completely automated, 100% automated, right? And then once you would realize how automated it is, you know, maybe some people, at least generationally, wouldn't go back to taking just their own car, right? But it's everything. The changes that could come through technology could be pretty dramatic. And when you think about us as forecasters, let me tell you a couple of things that I've noticed in everybody's energy models that came from working on this subject of peak oil demand, like what would it take to peak oil demand? And so we worked on that at UC Davis. There's still a team working on that. And one of our students who worked on that is here in the audience, Daniel Shadem. Raise your hand so everybody sees you. So the point is, one of the things we noticed in working with all these models, well, let's take step one. And then we at Rice did a lot of modeling on this. 10 years ago or 15 years ago, it was a very effective thing to model that as you got wealthier in different countries, the purchasing of cars would go up. And there was this one-to-one relationship between per capita GDP and car stocks. Well, that is no longer true in many major cities around the world. People become wealthy, and young people become wealthy, and they don't buy a car. And part of the reason they don't buy a car is because they're using ride sharing, and part of the reason they don't buy a car is different attitudes about durable goods, and part of the reason they don't buy a car is because the congestion and traffic in so many major cities around the world make it almost virtually impossible to get around by car. So that's one change that means that every model that we all use is over-projecting gasoline demand from private automobiles, not because we have the forecast for electric cars wrong, because that might be true too, but because we have this one-to-one relationship between wealth and car purchasing that is no longer correct. Second thing, freight. What are your assumptions about freight? Right? Your assumptions about freight, as Ed mentioned, was that it's going to be diesel, but you're seeing, increasingly some freight is moving to alternative energy. But now think about 3D printing. Adidas announced a couple weeks ago that they are going to put 2 new factories for 3D printing for their equipment, their athletic equipment, sneakers and so forth, in Ohio and in Germany. How many people would have been employed in manufacturing in Indonesia or Vietnam to make those sneakers that you would then wrap in plastic and put on a container and ship it to the United States, bring it into port, and move it up to Ohio by truck? Right? So how much of the freight logistics chain is going to evolve away over time from cheap labor to mechanization and less energy use? And people have studied how much electricity does or doesn't get used in 3D printing, and they've concluded that it's not energy saving because it's more electricity intensive, but that's not the right question. The question is, how is it going to change how goods get manufactured and shipped around the world? And what is it going to mean for the rekindling of manufacturing in end-use markets like the United States and Europe, which means that this whole Asia boom of the Asians getting the wealth in the first place through manufacturing to the middle class in Asia, and then everybody buys a car story, and they're all going to order off of Amazon.com or Alibaba and then get the goods delivered to them in China and all these places. If there's no manufacturing jobs because it's all going to robotics, then that whole storyline of how people are going to buy the car and drive around is also incorrect. And then if you take plastics, Ed mentioned that a lot of plastics is shifting to the excess for natural gas liquids. But, McKinsey did a study, again, on peak oil demand, where they looked at the trend to the younger generation and new businesses to lower emissions and to do more recycling. And they found that just a 25% increase in either eliminating plastics by design or through recycling would eliminate 3 million barrels a day of future demand for oil for plastics, right? So my point to you is all these things I'm mentioning to you are sort of long-term trend lines. It's hard to know how they're going to mix together with automated vehicles. Well, automated vehicles mean we're going to travel more VMT, even though it could be electric and more efficient. Like, it's hard to know how to model all those things. It's quite complex. But I can tell you one thing. If there's not a negotiated solution to the conflict that is escalating in the Middle East, whether it's in Lebanon or in the Gulf itself, and people start bombing each other and it starts to affect oil export facilities, the next time the price goes up, which it will, because there's only so much oil that can come from non-OPEC in a certain period of time, all of these technologies I just mentioned are going to become even more economic and be accelerated and deployed even faster. And if you think about that, we also did a study, Mahmoud and I, where we looked at discontinuities in the oil cycle. Like, in other words, what were the things that were most dramatically altered the pathway of the oil boom, natural oil boom and bust cycles is connected to the business cycle. And we found that the two biggest discontinuities came from technology innovation and from wars that damaged export facilities, right? So I think we're kind of like back in that, that sweet spot where you can kind of see, like, deer in a headlight, you can kind of see it coming, and let's hope that it doesn't turn out that way. But you can see that the pattern of the geopolitical risk of low oil prices looks like it could be pretty devastating this time around. And that's you can throw in what Ed was talking about in terms of failed states like Venezuela and others that are struggling, even at $50, which in the day wasn't even considered a low oil price. So I'm just going to add one more thing about OPEC and this phenomenon that I'm describing. So maybe there's going to be a lot of analysts that are going to write about whether OPEC can or can't make a deal since Iran and the conflict between Iran and Saudi Arabia is escalating. I think that's sort of not to the point. If you look at the events that have happened inside Saudi Arabia over the last week, right, what it really tells you is the current Saudi government has to be committed to its reform program to survive. Now, the reform program has this cornerstone of the Saudi IPO, Aramco IPO, but more importantly, delivering economic reform and economic benefits to average citizens, right? Doing that, in part, one of the upsides of finding people who have been engaged in intense corruption is that you can replenish the Saudi budget or sovereign fund, wherever the money is going to go, rather quickly when you arrest 500 billionaires and then freeze their bank accounts. If you presume that, if you even just do the calculation of $1 billion per billionaire, that gets you to the revenue that they were hoping to get from the Saudi IPO, right? So, but, and here's my but, I'd use the analogy of painting oneself into a corner. As we know, those of us who were around in 85, 86, you cannot control both production and price at the same time. And so part of the problem with being in that corner is it's been clear as a matter of policy that Saudi Arabia is now choosing price over volume. And it has these structural issues that are boxing it into that strategy. regardless of what's happening around it, right? The consequences of picking a volume-oriented strategy, could be pretty negative for the Saudi domestic politics. And so if you're the other members of OPEC and Saudi Arabia announced, hey, guess what, as they did back in the 80s under Yamani, we'll be the swing producer and we're going to cut. Where's the discipline mechanism? The discipline mechanism in OPEC was always the threat that the Saudis would flood the market. I would argue today that per the Wall Street Journal, having demand be strong this year, having the Saudis have oil field problems at the Manifa field, which is a major, major field, right, means that the sort of flooding the market theory or concept has really been pulled off the table, means that everybody in OPEC has the freedom of navigation to produce whatever it is they want if they feel they want market share without worrying about the sort of with impunity from a Saudi response. And that in itself is going to make it difficult for OPEC really to function, because you're going to have a rising price from geopolitical tensions. There's going to be no incentive for OPEC to cut production in real terms. You're going to have new production encouraged by the higher price. And then on top of that, you're going to have a fast-paced technology. So that's my observations. I look forward to talking to you guys in the questions.
Thanks very much, Amy. Sarah.
Okay, good morning. Thanks very much for having me here, and thanks very much to Ed and Amy for allowing me to hang out with them and share some thoughts on the future of energy. So I know we've got about a half hour left, and we want to get a lot of questions in, so I'm going to try and do a 20-minute presentation in 10, so you guys can grade me on Twitter afterwards if you think I did a good job. So I thought what I would add to this equation is, the context here is what is the U.S. role in these markets? And I think one of the new features of the market environment that both Ed and Amy have talked about so wonderfully about the history of all of the the history of oil markets is the fact that the United States feels quite emboldened. It feels like it has resources that it didn't have before and a lot of strategic advantages. And one of the key questions is, what do we want to do with that? So I'll talk a little bit about U.S. energy policy, but I want to do so in the context of how I look at the energy world. And I think one of the things that Amy started to talk about that I think is happening more and more in the oil market conversations that we're going to is you see that you can't really evaluate oil markets in isolation. They really exist in the context of a bunch of different geopolitical and market environments, but also the energy systems seem to be converging, and I'll talk a little bit about why I think that's important. So first, let me just start with 6 key observations that underpin how we're looking at the future. One, I think we're in the latter half of the oil and gas markets starting on a long road to rebalance. This doesn't mean that oil prices are going to be $50 forever, but it certainly does mean that we're not out of the woods yet, and the next year continues to look like a process of that oil market rebalance. What does that mean? Well, cycles are not over, as Ed talked about, but timing's going to matter a lot. There's going to be some sort of gap that emerges in underinvestment, and how we fill that gap over the next couple of years or next 4 years, depending on your outlook on that, is going to matter quite a bit. And one of the things that we're increasingly interested in is whether or not OPEC has an exit strategy. I think talking about OPEC as a monolith is somewhat problematic. I think they're constantly trying to convince themselves that one of their strategies is the predominant one and that they need to be continuing to follow it. But whether they sort of continue their cuts over the next year, I think, is a matter of a near-term phenomenon. What they do beyond that year, I think, is going to be of strategic importance to the oil markets. We still see economic headwinds. I think the last several years have been about coming out of an economic environment where we were wondering where recovery was going to be coming from. We still see there to be headwinds, though, particularly in emerging economies that matter a great deal, like India and China. Both because of the need for structural reform to be able to sustain that economic recovery over a period of time, Two, there is as Amy just alluded to, there is a lot of stamping out corruption in some of these really important markets, and we're seeing, as in the case in Brazil, that can have near-term economic headwinds in important emerging markets, and so we still see some volatility on the demand side of the equation there. And then, as Amy also alluded to, oil intensity of growth is something we're watching quite closely for no other reason other than there are actually policies and priorities out there to get oil out of GDP equation, and we think that that's going to matter over the years to come. I still see, we haven't really talked much about climate change. I think this bottom-up push for climate action is still very much going to be a determining factor of energy policy over the next several years. I think the lesson from Paris is not that the world determined that it was going to do something about climate change necessarily, but that there is a model out there of co-opting as many different communities internationally rather than sort of a top-down policy approach to taking on climate action that's going to be a definitive factor in where policies are coming from, and investments and other climate action will be coming over the next several years. We still see technology, policy, and market dynamics changing the electric power markets around the world in really, really significant ways. Why does that matter to the oil markets? Well, increasingly we see models of how that type of change is happening on the electric power side of the equation, influencing the way we might be thinking about oil and gas markets going forward. You're seeing oil and gas companies much more interested in what's happening in electric power markets. They're seeing the same kind of challenges to their own business model that I think the electric power market saw several years ago. They're not direct one-for-one analogies with one another, but I do think that there are some really important lessons to be learned by looking at the energy system as a whole and not just oil markets or the transportation sector and the electric power markets separately. Finally, one of the really profound things I think is underway that we've touched on, but I don't think we've sort of examined the roots of, is we're seeing a huge amount of geopolitical churn right now. Henry Kissinger, who sits down the hall from Adam and Guy and I, calls this one of the most important geopolitical realignments that we've seen in multiple decades. And it's happening because we have a shift in the big power politics, the sort of the above the water thing that we all think about, a rising China, a revanchist Russia, a real change in the power structures in the Middle East. But it's actually more profound than that, because each one of these governments and most governments around the world are also experiencing a host of transnational threats, whether it's questioning capitalism, the backlash to globalization, populist trends, that are really causing them to have to renegotiate their sovereign license and their right to govern with their citizenry. And I think to have both of those things going on at the same time make for a very, very robust and dynamic geopolitical environment that is quite challenging to foretell how that's going to change. And so we're watching that closely in different markets to see how that's going to evolve. And then finally, we see perhaps one of the most important areas of change in these markets going forward through the lens of economic statecraft, particularly with this administration, which I'll turn to next. We've got a lot of interest in how different governments are looking at trade relations with one another, both the U.S. rewriting trade arrangements and trade agreements, most profoundly in NAFTA, but also looking at Korea. And looking to sign bilateral trade agreements with other countries, but also through sanctions, as Ed alluded to before. Sanctions is the least path resistance policy in Washington right now, and much to the chagrin of many international actors, particularly in Europe, has very little to do with international politics and more to do with U.S. politics, so I'll talk a little bit about that. But we see this as a period of time where both the positive, the trade agreements, and the negative, the sanctions, sort of blocking agents in economic statecraft, to have the potential to rewrite a heck of a lot of what's going on in how energy is traded and people make investments. So what's the U.S. policy on all of this? I wish I could just tell you right out, but the catchphrase for it is energy dominance, and I'll get to what that may mean in a moment. What I'd like to say is I think that this administration has a number of overarching policies that don't have a heck of a lot to do with energy. They're not energy policies per se, but they are broad ideas about how the administration should run itself itself. And they do impact the energy sector. So the first is this idea that we need a much more pronounced national security posture, one in which the U.S. stands up for itself, does not lead from behind, and decides to have a much more aggressive defense of our sovereignty and our interests. That always matters. That always matters for the energy sector, and it certainly matters, particularly in this case, as we've repositioned ourselves relative to GCC countries and Iran in particular, how we've positioned ourselves against North Korea, and how we've positioned ourselves vis-a-vis Russia. It will continue to matter as we go forward, and I think one of the big sort of factors is whether or not we sort of see kind of a stabilization in all of those realms, and how the U.S. wants to continue to include itself in that national security and geopolitical apparatus. Second is economic nationalism, and this is perhaps one of the ones that people pay a lot of attention to in the trade realm, the idea that we need to create U.S. jobs, get better trade deals, simplify taxes, and cut foreign aid. We're seeing a lot of activity on this front right now, and it is one that is different, quite frankly, from a traditional Republican ideology of opening up markets and growing, and it is what we call the third axis in Washington. You used to think about liberals and conservatives, Republicans versus Democrats. Now there's nationalists versus internationalists. And understanding how that works itself into the policy agenda, I think, is important to keep an eye on. Finally, two more pillars of the Trump administration policy. One is the art of the deal. A lot of things that we're seeing, especially at the very highest levels of the U.S. government, are transactional in nature and not ideological. In fact, they can be ideologically inconsistent with one another at the same time. So that's an interesting trick to have to learn how to do. It also means that the president, and we saw this in the Asia trip this week, prefers bilateral agreements. Institutionalism and working through institutions is not the preferred method at this early date in this administration for achieving some of the agenda items that they want to go for, and see much more advantage to be gained through bilateral transactions. And then finally, I think perhaps the most pronounced part of the energy agenda that we're seeing coming from this administration comes through this idea that we have to deconstruct the regulatory state. And so when you divide up all of the action that this administration has taken so far in energy, the most forward-footing and most aggressive of that has been the deconstruction of the regulatory state, which is rolling back regulations, shrinking the size of government, and trying to enable the energy resources in the United States to be able to produce more, to be an engine for growth in the U.S., to be an engine for exports, and to remedy the sort of trade deficits that we're seeing with other countries. We've seen a lot of early action, particularly on the regulatory front, so within the Department of Interior, whether it's opening up access on the offshore, which they're well on their way of looking at a new offshore leasing plan, rewriting the old 5-year one, rewriting the new one, rolling back a series of regulations, anything that they see that blocks oil and gas and coal production on federal lands in particular, or with the Environmental Protection Agency, which has done a similar set of things. All of these things have moved quite fast early in administration, but we have to remember that unfortunately, or fortunately, depending on your perspective, because all of these are administrative actions, they will take a long time to prove out within the energy system and within the policy agenda. And so unless you see a fundamental change in the midterm election where Republicans get a lot more seats in both the House and the Senate, and they're able to translate some of these regulatory changes into legislative action, the sort of conventional wisdom is that these changes are going to take a long period of time, be very litigious to enact, and probably don't have as big an impact on the energy demand side of the equation as on the energy supply side of the equation here in the United States. And going along with a higher price environment, particularly for oil and gas, as we get back to the sort of recovery of those markets, I think you could see additional supply coming out of the United States. I think the view that Ed has about a very strong and robust U.S. position on oil and gas in particular going forward is not an illogical one. But what I'd like to just say is I think that when I look at the future of energy markets, and just maybe to add some food for thought for our conversation, I categorize it as the 3 C's. The 3 C's that are looking forward to energy markets. And this is something I'm not sure the administration completely understands yet. One, I think that the markets are going to be more competitive, and this is because of what Ed said, because there's more energy out there. There's not sort of the demand surge that we saw circa the sort of 2000 to 2007 period with rapid growth from China. And what we're seeing around the world is players positioning for what they anticipate will be a much, much more competitive market dynamic. They also have greater technology options on the table to be able to pursue. So I think that competition is going to be intense, and it'll be fundamentally different than in a supply-constrained market. Second is consumers. We see energy companies across the board become more consumer-facing. That hasn't happened in a long time. I think this is particularly pronounced in natural gas markets. People who want to sell gas and are repositioning their companies or their countries to be competitive in gas export markets understand that they have to win those markets for those assets. They're not just going to come to them because there's abundant gas. That doesn't make a market. So I think that a lot of energy companies are becoming much, much more consumer-facing, and I think that that'll have a lot to do with not only how you as consumers want to access your energy resources, as Amy alluded to, but also how emerging economies want to cultivate their energy sector. You're seeing a lot of countries out there saying, I want to follow the China model. I don't want just the cheapest energy you have to give me. I want to be able to produce new technologies myself and leapfrog some other energy systems. And so I think consumers have a lot of leverage in this market. And then finally, I'll just end on the crises. That's my catch-all bucket for all the other things that I don't have time to talk about. But I think that this is going to be, because it's such a profound period of change, I think it's going to be punctuated by a lot of different crises. And I'm not fear-mongering, but I do think that there's going to be a whole bunch of things that happen that the energy markets are going to have to respond to, whether it's on the geopolitical front, on the trade and sanctions front, on the resilience and climate change front, which we really haven't talked about here, but is certainly recalibrating some of the conversation about resilience here in the United States. And then finally, Amy had started to allude to all these isations that are happening in the energy markets: digitization, automation, robotization, all of those sorts of things. Those are going to be great innovations, and every company and country I talk to thinking about how they want to get ahead and be competitive are thinking about incorporating those into their business model. I think one of the dangers of that is that with every new network that you provide, you have a cybersecurity threat and a security issue associated with that network. So I think that's going to be a big theme going forward as well. I'm going to stop talking now. Thank you.
Thanks, Sarah, for that really exquisite ability to push 20 minutes into 10. And thank you all. We're open to any kind of issue you want to raise, any kind of discussion anyone might, and David Knapp doesn't surprise me by having his hand up.
David Knapp, Energy Control.
Yeah, I think you're supposed to use the mic behind you.
Well, I think the question that is on all of our minds is what happens on the 30th. Thank you for setting all that up. There are some differences of opinion around. I think the consensus, at least on the people that I've been talking to on Wall Street, is yes, it's going to be done on the 3rd. I know that you don't agree with that, and you have a couple of fairly high-profile supporters for not doing it on the 30th. And the argument that I hear on the other side is that you'd need an extraordinary meeting to do it in March. So just saying, well, let's wait and see, makes it more difficult. These extraordinary meetings are always hard and they're dangerous. So how would you respond to that? Thanks, Ed. And great presentation by all three of you, by the way.
Sure, and I guess since you aimed that at me in part, I'll try an initial response, and then Sarah and Amy can chime in. I think the market is positioned in a very dangerous way on a consensus that it is logical to extend the agreement through the end of the year, and maybe with a variant on that to extend it through the 3rd quarter and then have a plan of action for the end of the year on how to bring whatever the number is. I think it's like 1.2 million a day rather than 1.8 million barrels a day, but bring that oil taken off the market back into the market without disrupting the market unduly. So the market, without knowing a poll of thinking on it, but my personal poll is that the overwhelming majority of the number of people I talk to outside of OPEC and hedge funds in the business community believe that it is logical to do the extension, otherwise you're going to trigger a sell-off. The market has become unbelievably long, and it's become unbelievably long beginning with the hurricane season, when just before the hurricane season, the market was particularly short, actually. The amount of net length of managed money was at a very low level, in percentage terms, as low as it has ever been, and then there was this dramatic march forward, both in managed money length in ICE Brent and in CME WTI. And in the data indicate that, or the daily data indicate that there has been a piling on with the news that Amy referred to, news about potential outbreak of armed conflict. You can't have a level of net length that's at absolutely the record level in pure volume without triggering a sell-off at some point. Now, whether the sell-off is on November 30th, this is it's a fragile number. And it's particularly fragile in that once the sell-off begins, there's a multiplier effect to it as people have to cover their positions. And the last big sell-off trigger point was actually March 6th. It took place in an event in this city when Zero Week happened, and on March 6th there was what was visibly seen by those who Dan Yergin had invited. So he invited a lot of hedge funds, he invited a lot of independent producers to meet with OPEC ministers who were here in plenty. And the market perceived an argument between Alex Novak from Russia and Khalid Al-Faleh from Saudi Arabia, and they thought the argument was about compliance, a lot of pointing of fingers, and they ran to the door. And there was after the close of the market, an incredible sell-off that didn't want to stop. It paused several times, but it didn't want to stop. So you had you had both Brent and WTI, which were trading the last week in February, the first week of March, around today's level, and then they fell to, $15 below that by the time we got into June, with just a couple of pauses on the way. Sell-offs can be quite dramatic. So when I wrote what you referred to, I had come to the conclusion that major market participants did not want to have an extension to the agreement at that moment in time on November 30th, but wanted to postpone it to an emergency meeting of one sort or another. I'd say the logic of positioning is that there is an election in Russia. Mr. Putin doesn't want to see very much turmoil in the markets before that election is over, certainly doesn't want to see a sell-off. So I would think that there would be a position either to extend the agreement by a quarter to the end of the first half of the year, or to do nothing as the two logical things. And I believe that the positioning in the market is such that even an extension to the end of June would trigger a sell-off as disappointing. And if we look at every OPEC meeting, whether the market is right or wrong beforehand, more or less every OPEC meeting ends in a sell-off financially. So I think there's that historical element to it as well. Amy or Sarah, do you want to add anything to that?
I would just add that to what Ed said about Russia, same with Saudi Arabia. I mean, there's no party to whoever's coming to this meeting that people are at a particularly sensitive time where they can't afford to have a sell-off right now. So you would think that that would really constrain any decision that's going to be taken in OPEC. I think there's a sense that these geopolitical difficulties, which if you think about it, if you're Russia or Iran, you feel you can actually control some of them. Maybe you could add Saudi Arabia to that list now, because people can take a military action and be kind of guaranteed that it's going to help keep the market up. So I don't see the point of wrecking things inside OPEC. I mean, there's no one who gains from that. In the past, in 2014 and 2015, the Saudis were kind of a wild card because they had different geopolitical goals, where a low oil price might have helped some of those goals. But I don't see them taking that stance. I don't think the Saudi approach to conflict with either Iran or Russia right now over these other geopolitical things. I think the dangerous thing is they don't see oil as the lever. They see military response as the lever. And then if you look at the president's tweet, our president's tweet about the Aramco IPO being listed in New York, there's kind of an implicit statement in that, which is if you're Saudi Arabia and the president's saying he wants good trading and business in the United States, the last thing in the world you're going to do is do something to knock out the shale production.
Sarah?
No, not much to add. I do think that there's I think that there is something to the fact that the geopolitical pressure right now, along with a perceived tightening of the market, is leading to higher prices. But I just don't, I think that the idea of extension into next year makes a lot of sense. And I can't imagine anybody wanting to cut prematurely or make a cut decision prematurely because they need that option for next year more than they do right now.
I'd like to make two other observations on the OPEC meeting. Amy had said in her remarks that Saudi Arabia may be giving too much away by saying that they would even unilaterally cut if needed. I don't think anybody else can put, Kuwait and the UAE can add production, but if you look at the group, no one else can add production to the market. So there's very limited likelihood of a free rider problem. On the other hand, there is something about the U.S. that is lurking there. And the way we model shale production, there is a lag between a price trigger and hedging or not hedging and the rig count. And there has been just an astronomical amount of hedging taking place once the calendar year swap for 2018 and now the calendar year swap for 2019 is above $52 a barrel. It may, we think that the price increase and the hedging that's taking place is going to add a significant amount of U.S. oil to the market next year, to the point where we were in August believing at an 800 to 900,000 barrel a day increase year to year in U.S. production in 2018, and we're now looking at 1.2 million to 1.4 million based on the hedging activity. If this is right, then rig counts are going to go up starting in January and February. There'll be a bearish mood in the market. If you add the U.S. production to U.S. production growth, expected growth from Brazil and Canada, yet again, you're way above wherever demand is going to go. And it means there is no room for OPEC oil to go into the market, not in 2018 and not much in 2019. So it looks pretty bearish into that going forward, and then the group has to be dramatically challenged if there is no opportunity to put more oil in the market. I sound like you. I read you. Anyone else?
So Martin Sturmer from the Federal Reserve Bank of Dallas. Will the Saudi Aramco IPO happen? If so, when and where? And what will be the effect on OPEC's actions?
Sarah, Amy? I work for a bank. I'm not allowed to talk about the IPO, so I'm out.
Okay, I guess I'm the only one who's allowed to talk about it. So I would say that the Saudi government has to be committed to doing something related to the IPO, right? I think for certain it would be politically wise and positive for shares of Aramco to be listed on the Saudi stock market itself, because, if you think about like the Alaska Permanent Fund back in the day, it's kind of like saying not only am I collecting back up wealth that was taken ill-gottenly from the state, but I'm going to offer a stake in Aramco to average Saudis who can trade on the stock exchange. The original announcement about the Saudi IPO was a little unpopular on the popular level in Saudi Arabia, and so at least listing it on the Saudi stock exchange ameliorates some of that. Good way to save face, right? Because we're definitely offering the shares. Positive statement for reform in Saudi Arabia. The Crown Prince has made part of his rationale behind the IPO to bring more transparency and efficiency to the national oil company. You know, all of our studies on national oil companies show that having some kind of share listing is a positive feature in that regard. So to me, it's like a no-brainer to list it on the Saudi exchange. You know, once you go past listing it in Saudi Arabia, then I think you start to get into difficult territory. And that's what I mentioned, this thing about, you know, controlling both price and volume, right? So I originally wrote a blog, which you guys can Google for, it was on salon.com, about how all of the IPOs, so we've done a lot of writing, I've done a lot of writing on national oil companies and IPOs and generally put them as very positive impacts. But all of those IPOs took place in a world where not me, but many other people believe that resources under the ground were going to appreciate over time, and we were going to run out of oil except for the national oil companies. So that meant that investors, when Statoil went IPO, and when, you know, even Petrostar of China went IPO, when all these IPOs were done, Petrobras, there was this belief that you wanted to own reserves, right? Because they were going to become more valuable over time. Well, cut off now. You know, now you're putting out an IPO for something that might be related to reserves for the first time since we all started thinking that reserves might depreciate under the ground. And it's almost like a test case for the value of stranded assets. You couldn't come up with a better test case than Saudi Aramco because they have some of the biggest reserves under the ground ever. And if you look at the collapse of China Petrostar or how badly people have done owning Rosneft or some of the other companies, you know, it's difficult. So when I wrote that, another very, very good blogger, Robin Mills, who I have a lot of respect for, put out a new blog saying that I don't understand the IPO because it's going to be like an annuity. It doesn't matter whether some reserves are going to get stranded at the end of time. The valuation is going to be based on your presumptions about production, which is going to be steady. But I tell you now, talking about painting into a corner, you know, how am I going to convince investors that production is going to be steady? Am I going to say I'm quitting OPEC and I'm no longer going to make production cuts? Because I have to make the production cuts to guarantee you the $60 price you need to be willing to buy the thing in the first place, right? And then the second problem is, if you wanted to invest in Saudi Arabia, you could buy a bond, a Saudi bond, and get 3.5%. So why am I taking this extra risk? What am I going to get, 4%, 5%? How much extra risk do I have to take as a Western investor or a Chinese investor to go beyond the 3.5%, which is a good yield, right? So I think it's going to be a tough sell going beyond the Saudi market. And, you know, people have all kinds of things they're saying about why you'd want to buy that share, right? They might consider packaging it the way China Petrostar did, where they pick out some plum asset or something and package it in a different way for Western listing. But I think it's going to be pretty challenging. And what's the storyline that you're going to go out to retail customers with?
One way of tracking Saudi thinking is there is a new, relatively new foundation called the Arabia Foundation. The head of it, Ali Shihabi, speaks the mind in a way of Mohammed bin Salman. He has recently written on the IPO subject. He did a tweet against the Trump tweet on how they like the IPO, and he said, and what's going to happen with JASTA legislation. He also has said in writing in the Arabia Foundation publication section that there's been a lot of talk about private placement to large sovereign wealth funds and to large institutional investors who are looking for yield. And that's certainly a plausible route, just if you look at what sovereign wealth funds have said about their interest in that investment, what the Japanese government has said, particularly in terms of whether the Aramco shares were listed in Tokyo. And there was a kind of critically interesting statement that Khalid Al-Fallah made in Moscow recently, when he accompanied King Salman, which was to acknowledge that the Russian government had offered capital for that, and it would not happen. It's about 11:30. We can go over a little bit because we started a little bit late, and then everyone can go
Ahmed
and
Khalifa.
can have food. Yeah.
Ahmed Khalifa, Qatar University. I have a few strategic questions about Saudi Arabia. They will offer around 5% only, by the way, from Aramco, and they insist to do that. They have a strategic plan for development and so on, in collaboration with other countries. My question about this is the 5-year plan, or the 5-year prediction about the employment level in different sectors. Do you think after 2040 we'll have the same growth level of demand on oil after maybe a successful ITER project in South France, the international collaboration project between USA and the rest of the world? Do you think that the strong demand on oil and gas will sustain after this 2040?
So I say, my opinion is, and it's very hard to take conventional models and show that it's not going to, because they're so dependent statistically on population growth. But I think the chances of demand continuing to grow in the way we've seen it today in 2040 is very slim, very slim. And I think it's because there's going to be so much change in how we use energy in daily life and where that energy comes from. It's almost hard to anticipate what things are going to look like then in terms of urban mobility. I'm not even talking, if you sit and just count cars in the car fleet, I don't think that that's really the issue. The issue is what kind of goods are people and services are people going to buy? How are they going to receive them? How are you going to use or not use plastics in daily life? I mean, it's just not sustainable to take the amount of plastic we use today and dump it under the ground and into the ocean, right? So I just think that there'll be a change.
Sarah, you want to add anything?
Yeah, no, I tend to agree with that. I mean, the thing that's most interesting to me is that I think the politics of energy have changed a lot in the last decade. And I think that when you look at corporations, whether they're privately owned or state-owned enterprises, they're actively pursuing worlds in which fewer hydrocarbons are consumed. And until that stops, it takes what is sort of a natural market phenomenon of us shifting from fuel to fuel, and it gives it an adversary. I mean, I think if we pretend that there aren't other technologies out there that are battling for market share from oil and gas in the marketplace, then that's ignoring what a lot of what's happening. And so I think that there are significant headwinds to increasing oil demand and gas demand in those futures. I would say that's why, whenever I talk to folks about the future of oil and gas, they're looking for alternative uses for those resources that they think fits a profile of the changed world, in a post-2040 sort of time frame. Can I just add one word on the IPO really quickly?
Do it.
I generally think it's more important that it's successful than that it happens, right? And so I think that makes the timing of the whole thing relatively fluid. So I think that I like Bassam Fatou's writing on this from Oxford, who basically says, yeah, oil prices matter, but strength and confidence in Saudi reform domestically is a huge factor. And so whether or not that seems to be going well, I think is going to be a driving factor in people's confidence in what they're willing to invest, because you're investing 5% in something that is fundamentally a state-owned project. And so if you don't have confidence that they've fixed that, all the things that worry you about that, then you're going to have a harder time investing there. The two other interesting things are, one, I think Ed alluded to it, but the riskiness of listing in the United States for the Saudis is pretty high. And I think that there's a lot of people who talk about that. Real concern, why would they list in the United States? We basically just passed a law that said we could sue them for whatever we felt like. So I think that's probably a problem in their perspective. I do wonder about this sort of Shark Tank effect, and I say that because I watched a lot of Shark Tank when I was on maternity leave several years back. This idea that they want a private buyer to come in, improve the valuation that they see at a smaller percentage of that 5%, to give them the validity in the market that they think that they can list on, like as a two-step process. I don't know if that works. Ed would be able to tell whether that works or not, but I see that as maybe being compelling to them, because I don't think they want to come in for far less than what they've got for a valuation, and I think they were looking for strategies to help them deliver on that. So I think that there could be more sequences to this act than we think, but I think it's more important for it to be successful than that it happens.
Thank you very much, and thank you for staying, and I hope we've had a helpful conversation.